One, two, 1, 2, 3, 4.
Hey everybody, welcome to the Sales Hacker Podcast. It is your friendly neighborhood podcast host and impresario, Sam Jacobs. I'm the founder of Revenue Collective. That's the business that I run when I am not hosting this podcast. Revenue Collective is a global community of revenue executives in customer-facing roles all over the world that are coming together online via Slack and other mechanisms and offline via a series of events to accelerate each other's careers. We're at 400 people, if you can believe it. We were, I think, 50 people a year ago, maybe 40. So we're growing really, really rapidly. We had our first members from Berlin, from Tel Aviv, from Paris. In addition to outreach that I've received, they may be members at the time that you're listening, from Barcelona, Oslo, Norway. So we're growing rapidly. It's incredibly exciting. NPS of 66. So it's going great. Now, Today's show is David Skok. You should know who David is. If you don't, that's on you. David is one of the pioneers of SaaS. He is a serial entrepreneur. He started his first business in 1977. 3 of the 4 businesses that he was involved with went on to IPO. He's an incredibly successful entrepreneur and an investor, one of the early investors in HubSpot and Zendesk, including in a bunch of other businesses. And he really developed the language of SaaS in many ways. He pioneered the 3-to-1 LTV to CAC ratio, if you can believe it. So this is a get. This is one of the great interviews and really, really informative. So I'm glad you're here. Before we listen to David, we want to thank our sponsors. We've got 2 sponsors. Conga is the first one, the leading end-to-end digital document transformation suite. With Conga, you can simplify documents, automate contracts, and execute e-signature, so you can focus on accelerating sales cycles and closing business faster. Go to go.conga.com/saleshacker for more information. Our second sponsor is the company that you know and love, Outreach.io, the leading sales engagement platform. Outreach supports sales reps by enabling them to humanize communication at scale. From automating the soul-sucking manual work that eats up selling time to providing action-oriented tips on what comms are working best, Outreach has your back. Now, without further ado, let us listen to David Skok. Hey everybody, it's Sam Jacobs. Welcome back to the Sales Hacker Podcast. We've got a very, very special guest on the show today. Probably some might call him the godfather of SaaS. Other people might call him just the father of SaaS. It depends on your generation. But one of the most well-known thinkers, investors, entrepreneurs focused on the entire sort of growth and evolution of the recurring revenue business model. I'm talking about David Skok. David is best known for his blog, forentrepreneurs.com, which covers many startup topics such as SaaS and how to build a repeatable, scalable, and profitable growth machine. He's a serial entrepreneur who founded a total of 4 companies and did 1 turnaround. 3 of those companies went on to IPO. In 2001, he joined early stage VC Matrix Partners as an investor. He's been an early investor with exits in HubSpot, JBoss, AppIQ, Tableau, Netezza, or Tableau, I might have said it wrong, Diligent Technologies, CloudSwitch, Tribe HR, GrabCAD, OpenSpan, and Inservio. He serves on the boards of Atomist, CloudBees, Digium, namely Salsify and Zayas, or he'll tell me how to pronounce that. And he focuses on early stage investments in enterprise software, SaaS, cloud computing, open source, and more. David, welcome to the show.
Hey, Sam. Yeah, it's great to be here.
We are very, very excited. We're going to dive in. But before we do that, although I just read an incredibly impressive bio, there are people out there that amazingly are less familiar with your work than others. And so we always start with a section that we call the baseball card. So we know your name. Is your title general partner, I suppose, at Matrix Partners?
Yeah, that's right. Yeah.
Perfect. So tell us about Matrix. How big is the fund? What sort of stage of investments do you make? Just tell us a little bit more and give us a little bit more context.
Yeah, very quickly. It's a 35-year-old firm. It does Series A stage investments, and we are on to Fund 11, and we always raise about a $450 million fund. And we also have funds that are operational in China and in India. And China actually turns out has been the really hot market to have been in for the last 10 years or so. So it's actually been great to have been there as well as the States.
Again, for the folks that aren't as familiar with your background, I just rattled off, a stat that's sort of buried in the bio, which is that 3 of the 4 companies you started, you are an operator, and 3 of those 4 went on to IPO. How did you get into this world originally? I think I read in a longer bio that you started your first company the year I was born, 1977. So tell us about, your background. It sounds like maybe you're from South Africa. Walk us through your origin story.
Yeah, very briefly. Born in South Africa with an English mother, and because apartheid was pretty much a key thing going on in South Africa at the time, my parents wanted to get me out of there. So they moved me to England to go to school there when I was 8. So I finished all of my school in England. And I was one of the very first people to ever get a computer science degree in the UK at that time. It was the first year that 2 universities offered computer science. So I was super excited about that, really loved the idea of what computers were going to be capable of doing. And I came out of there and wanted to go to MIT and had a small problem, which is my father had a strong desire to try to get me into his business. He'd even called it Robert Skok and Sons. So I did a deal with him. I said, listen, I'll come out and work for you for a year, but at the end of that, please pay for my MIT continued education. So I went out there and he had a machine tool business. And what happened was he put me through this apprentice training course. And I saw this new kind of machine that was coming out, which he used a punch paper tape to direct the machine tool. And I realized that all these guys who were on this apprentice training course with me were the typical operators of machine tools, and they didn't even pass their high school exams, let alone going through college. And so they had to figure out the geometry to be able to code this machine. And secondly, if they punched a single extra zero in that tape instead of going 10 inches, this $100,000 machine tool with enormous amount of horsepower would actually go 100 inches and potentially, do enormous damage to them. And I've seen that happen. It's incredibly dangerous when it does happen. So I sat there and I thought, what can I do about this? So I wrote a piece of software to help automate the programming of those machines. And accidentally, without realizing what I'd done, I ended up starting my first business. So no intention of starting it, no kind of careful thought about what I was doing at all, but started selling the software. And I got stuck in South Africa for a number of years because that business was pretty successful. It grew to about 30 million a year with 24% pre-tax profits, and it had no venture funding or anything like that. It was totally bootstrapped.
And this is in the 70s. So this inflation adjusted is 50, 60, 70 million a year.
Yes. Yeah. And the nice thing was profitable too. So, it had to be profitable. There wasn't such thing as venture funding in South Africa in those days at all. And so it had to make money. Otherwise, we were not going to survive from day to day.
Wow. And what happened after that? So did you sell that business? How did you find your way to the United States?
I used it as a vehicle to come to the States, came over here in 83, got venture funding for a US venture that bought the South African entity. And at that point in time, we'd morphed from being CAM into CAD CAM and then into really focusing on architectural CAD, which turned out to be an area where there was a lot of attention and capability. So came over, and 83 was pre the IBM PC. So this is going to seem really strange for those of you who are a lot younger than I am. But we had to effectively try to figure out how to morph our business from workstations and a high price point to a channel business at a much lower price point. And in all candor, we didn't succeed particularly well. So that business ended up getting sold. And I went on to doing my next company after that, which was based out of London, selling software to corporations. As the IBM PC took off, we worked out that there were all these hardware stores like Computerland and Businessland, but nobody was focusing on the fact that really what made these computers interesting was software. So I started a business, and at the time also co-founded it with this US venture called Corporate Software. And I did the European part of it. And we then combined the two companies, and the combined entity went public around about 1987, I think it would have been approximately, or 88 approximately.
Wow. So from a very early age, you've been in charge, leading organizations that, even by today's measures and inflation-adjusted dollars, are incredibly successful, incredibly large. Did you feel like your childhood and getting to know and spending time with your father was the thing that prepared you? How did you develop a point of view and a perspective on business at such an early age that equipped you to lead all of these different organizations?
Yeah, I think it's a great question. Strangely enough, I think my father was the perfect example of what not to do. I loved him dearly. He was a wonderful human being, but he was terrible as an executive and terrible as a businessman. So, he used to shout at his employees, and I just naturally cringed every time I heard that. I'm a very empathetic person and really care about how other people feel. And that just struck me as being, you can't run a business that way. That's going to be disastrous. So he was a good example of what not to do. And I think a lot of it came from just plain gut instincts of how to survive, because the business fortunately grew pretty slowly. So I had time to learn a lot of lessons that ordinarily in today's startup world, you just don't have that time. Everything's moving at a much faster pace. Your competitors are moving at a faster pace. So you have to go really quickly, and you need to have, you don't have much time to learn lessons and make mistakes today. But I had that time, and I did make those mistakes. And I think I ended up learning a lot of just common sense business things. And I will tell you, one of the most interesting things that triggered some of my later on thinking was I had this 9-month sales cycle in my very first business selling to architects. And I sat down one day and I said to myself, this just doesn't make any sense. What's going on in the sales cycle? Why is it taking so long? And what could we do to make it work better? And I figured out that at least 6 months of that was education, where they didn't know what CAD was and how it would work and what it could do for them. And then in the last phases, they really needed to see other customers using it. And then they had to figure out what they were going to do in terms of financing the thing, were they going to do a lease or a suspensive sale. Both had different tax implications. And then lastly, they were always pestering me about, could they see this thing in a network? And networks in those days, LANs did not exist. So we were in the very early days of networking starting to emerge. And I didn't actually have a network that I could demonstrate to them. So that was constantly a thing that caused everything to stall. So what I ended up doing was I figured out if I could address every aspect of the sales cycle in an event, let's see what would happen. So I created a single-day event, brought these people in, the architects in. We had about 700 of them or so come through this event. They came in for the night beforehand. And we set up this room where we brought our customers in and we sat them carefully at tables next door to our prospects. We went through this audiovisual presentation of how CAD could have changed things in history, which was just kind of fun and got people into a good lighthearted mood. And we used a comedian to get the audience talking to one another, because we knew that if they didn't have something like humor to get them talking, they would just sit there stiffly at the tables and not talk to their neighbors next door to them. The comedian worked really well. And then the next day, we ran the educational portion. We had a financial person come in and talk about lease versus suspensive sale, and we pre-qualified them for how to get financed. And then for the first time ever, I had a network set up. And it was able to show exactly how several architects could share documents together. And I had this room where we had a whole bunch of customers and their drawings everywhere around this room. So you could see and talk to customers. So we effectively try to address every part of the sales cycle. And a strange thing happened at about 2:00 that day. The first customer came over and said, I want to place an order. And we never expected that would happen. So we quickly had my assistant type up this order form, run down and get it photocopied. And all of a sudden, in that one day, we did $4 million worth of business, which was more than we'd done in the whole 12 months previously. So that was the origin of me starting to think about, I had this scientific mind, this engineering mind that came out of my computer science degree, being applied to the sales process, and trying to think about, there's an art in sales and there's a science in sales. And if you can match those two things and apply both science and art to what you're doing there. And I think, to me, the art of selling is about understanding your customer's mind and really being an expert at reading what they're thinking about and why they're not moving quickly when you want them to move quickly. Why are they not doing the step that you want them to take? And then the science part of it is thinking in terms of metrics. How does this funnel work in terms of metrics? Well, you put a certain number of people in and you move them through steps, and they either convert or they don't convert. What's your conversion rate? So you end up with these metrics that come out of it. So I think you find that thing that happened back in the 70s, actually it was in the 80s, that particular event, has been highly influential for all of my later stage work that was all about, how to bring more of the scientific process to what had, up until recently, I think, in the early 2000s, art sales was never really thought of as being a very scientific and measurable, metrics-oriented, data-oriented, process-oriented thing. It was really much more about how do you have these fabulous salespeople that really know how to excel at closing large accounts with their charisma and charm, etc.
When did you discover your love, or did you discover your love? But when did you discover your passion for recurring revenue businesses? I mean, obviously, anybody that's worked in a recurring revenue business versus a transactional business, as an entrepreneur myself, I've discovered my passion and love for them on the first of every month. But when did you realize that sort of SaaS and/or service, basically turning transactions into an ongoing service, was the future of business?
Yeah. So in 2003, I invested in this company called JBoss, and they were making a free application server that competed against the IBM WebSphere product. And there was another one out at the time that I'm blanking on. But anyway, the important thing was that they had about 5 million people that they had given a free version of their software to, the open source downloads. And we had to figure out a business model to turn that into revenue for them. And the initial idea behind that was, okay, let's sell them support and get them into just an annual contract so that they could actually get support, because larger enterprises were never going to use open source without that throat to choke, and support was the way to give them comfort that they could use it and put it in production. So we created this annual subscription. And it was an interesting idea because not just support, over time we ended up putting lots more things into that. Like there was in particular some important software that went into that. And effectively that was the very first SaaS experience that I had. And it was before the real explosion in SaaS, which happened, I think, more around about 2008, 2009 was the early days of things like HubSpot and Zendesk taking off. And what happened was we started to realize that if you've ever run a business based on license sales, at the end of the quarter, you feel great for about one day. And then the very beginning day of the next quarter, you realize, oh my God, I've got to do that climbing of that mountain all over again and try to recreate that revenue, because everything I booked and billed last quarter is gone and is no longer going to be of any help to me. And if I don't book brand new deals, I'm going to have zero revenue this quarter. And that was an incredible change. When you get into recurring revenue, you start off with everything that you had last quarter, and everything you sign up now that's new is additive on top of that. And that was just a mind-blowingly incredible business model thing to give you comfort as an entrepreneur. And you also realize that as investors, when you're working with companies, one of the most valuable things is to have a predictable business. And companies that were out on Wall Street that had any kind of a quarterly miss would get punished heavily. And if Wall Street could see that there was something that was going to be really predictable, they would love it. So that was the year 2003 when I fell in love with it. And it took a while before we saw then SaaS businesses emerging. And two of the very first investments that I got involved with in the SaaS area was Zendesk and HubSpot. Zendesk I passed across to my West Coast partner because he was more easily able to handle that board seat than I was. But both of those were obviously fit a new kind of a model for what software was looking like. First of all, they addressed the SMB and not the enterprise. And as a result of that, they had to come up with a much different sales model that was far lower cost than the old enterprise sales model, because the price points were so much lower. And we were super excited about how the SaaS model would enable SMBs to finally use technology that they hadn't been able to do before, because the cost of having an IT department to use that stuff was something that was always prohibitive to them.
I remember, this is perhaps too graphic, but 2010, I was working at a company called Axial, and our founder, Peter Lehrman, had photocopied pages from your website that listed out and explained SaaS metrics, and he hung them in all of the bathrooms. So as we were using the bathroom, we would be staring at CAC to LTV and trying to understand renewal rate, which I think was brilliant. But so to the point of, the explosion of SaaS, I feel like at least you popularized, if not invented or created or derived, a lot of the key frameworks with which we analyze SaaS businesses. A, is that accurate? And B, I guess, walk through the evolution of how you came to use all of these different frameworks to analyze a business effectively.
Yeah, excellent. Well, the thing that I realized was that when I talked to my partners about what was going on inside of a SaaS business, they would struggle because they would see us burning a lot of money and they wouldn't know why we were burning that money. And their constant sort of request to me is, let's reduce the burn rate of this company. And I said, well, no, you don't want to do that because this business is really successful. And the reason why this was happening is that they were used to using traditional GAAP accounting statements, P&L and balance sheet, to understand if a business was doing well. And those totally fail to describe what's going on in a recurring revenue business, because you end up spending a fortune to acquire the customer in the early stages of the relationship with them, and you don't make that money back for quite a while. And the net result of that is that on a per customer basis, you're really negative cash flow for quite a long time. And it only if you've managed to keep that customer for several years do you really start to become profitable on that investment. And if you take that across many, many customers, you end up with, again, a very serious cash flow problem, or at least a profit and loss problem for the business. And getting people to understand why that was a good thing to be losing that money in some cases and a bad thing in certain other cases was a fundamentally needed problem to be solved. And that's why I thought unit economics were by far and away the best solution to that. And that really meant, looking at LTV of that customer and the CAC for that customer, and realizing that if you're going to have a great business, you'd have to have much more LTV than it costs you to acquire them. And also then thinking about the cash flow side of it, that led me to this other metric, which I think is extremely important, which is months to recover CAC. And I came out with a couple of guesses in 2008 about what those metrics should be. My guess was that LTV to CAC should be at least 3 times, and that you should try to get months to recover CAC to be less than 12. And in retrospect, I think they were pretty good guesses.
Pretty good. Still the standard.
Yeah. And so I would probably say right now that when I look at businesses that are really doing well, on average, their LTV to CAC is probably more like 4.5 or higher for the really good businesses. But I think at a minimum, if you're not near 3, you should stop trying to expand that business and go and fix that particular thing. And then if I go back and I look at months to recover CAC, that's really a metric that talks about how capital efficient the business will be. And what I've discovered is that back in those days, it wasn't easy to raise large sums of capital for a SaaS business. So 12 months was a very good target to aim for. These days, it's actually much easier to raise pretty large amounts of money for a SaaS business. So you could be more relaxed on that. And I would probably say 18 to 20 months would be, you don't want to be higher than that for the long term. You might be higher for your early days, but after a period of time, you certainly want to try to get below that. And if you can, the really great businesses are definitely in that 12 months and below range, and they consume very little capital. So the founders end up owning tons more of the business by the time it reaches some kind of a point where there's liquidity and they can get some kind of exit for their shareholding. So I relax the 12 months, but I think, and that's the 3 months thing, I would probably make that a little higher and say, hey, if you really want to be successful, you probably should be thinking about more like 4 or above. When you look at some of the great businesses on the stock market, like Zoom, they're up above 9 times LTV to CAC.
So first, just to get our definition straight, when you talk about months to recover CAC, is it revenue or is it gross margin or operating profit as you're thinking about the comparison against the CAC expense?
Yeah, so that's a good question. I originally used to think, hey, every SaaS business is going to have a really high gross margin percentage, so you could look at just revenue. Turns out that's not true. There are quite a lot of businesses out there where they actually have lower gross margins because they have to use a lot of people to deliver their service. So I think you have to look at gross margin. And what you're really looking at is, for an average customer, what is the gross margin dollars that you'll receive? So let's say you sold an average customer pays you $10,000 per year, and your gross margin is something like 70%. So you're then making $7,000 from that customer. So that tells you that your CAC, if you want it to be recovered in 12 months, you can spend $7,000 to acquire that customer. And it's very useful to know that, because now all of a sudden you can work out how much money you can afford to spend on sales and marketing just based on your price point. So if you, for example, are trying to sell something for only $50 and your gross margin is, say, 80%, you're only making $40 per customer. Well, guess what? That tells you that you shouldn't be spending much more than $40 to maybe $60 to acquire that customer, particularly if you can't retain them for a good long period of time. because you're just not going to be profitable on that business. So it's useful to put that formula into reverse to figure out, okay, based on my pricing and my average gross margin per customer, how much can I afford to spend on sales and marketing, which was what we just did.
Do you ever worry, this is my worry, so you can, as a professional investor, which I am not, you can tell me if my worry is misplaced. I worry that early stage companies describe and discuss and present LTV data that is completely unrealistic given their age as a company. And maybe they've had one or two cohorts that are representing or reflective of the LTV data, but the reality is that they've only been around for 3 or 4 years. So for them to say that their LTV is that on average a customer stays with them 4 years, 5 years, it's not provable because they haven't been around for 4 or 5 years. Do you ever worry that LTV gets dramatically inflated and sort of optimistically presented?
Well, you've just raised a great point, and I really feel like I'm partially responsible for a lot of entrepreneurs focusing on LTV to CAC and months to recover CAC way too early in their life cycle. And I kind of have tried to solve that problem with later materials that I produce. So if you don't mind, I'd love to go through this new framework that I figured out that I think is one of the most valuable ideas that I came up with. And it's the notion that most of the mistakes that are made the big mistakes that are made by startup founders is that they try to rush through the stage that they should be focusing on and jump to the next stage too quickly. And I came up with a 9-stage model to get to what I think really gives you a successful business. And that is when you have a repeatable and a scalable and profitable growth model. And in those 9 stages there, I think it's super important to recognize that you're just too early to calculate LTV to CAC when you're still trying to find product market fit. Or if you're in the early days of trying to figure out a repeatable sales motion, well, you don't have anything really that's repeatable enough to measure at that point in time. So don't bother estimating your LTV or your CAC at that stage. It's only when you've got something that's fully repeatable that you also know is scalable and you've started scaling it and have figured out what it costs you when you start to scale it. Because now you've got to generate leads at scale. You've got to find salespeople at scale. Then you finally end up with valid metrics for CAC and you have a decent enough picture of what your LTV is. And that's why the last phase in that sequence of 9 steps there is make it profitable. So let me just quickly go through the steps. There's 2
Please.
big phases. The first one is really all about finding product market fit. And the second phase is all about building this repeatable, scalable, and profitable growth process. And then once you've got that, you then would hit the accelerator pedal and start scaling like crazy. And what I've done with the 9 steps is I've broken those earlier 2, the find product market fit and the search for repeatable, scalable, and profitable growth down into these 9 steps. So briefly, to kind of go into this a little bit, because I do think it's super powerful as a framework for entrepreneurs. I'm not going to cover the product market fit thing because I think that's been well discussed and pretty well understood in the whole lean startup movement. But it's after you've found product market fit that you start trying to figure out how do you sell something. And I think the one first step in that is that the founders need to get out there and figure out if they can actually sell the product and make several sales and figure out at the point in time where they're making several sales, is what they're doing repeatable, and could they describe what they're doing to a ordinary salesperson and have that ordinary salesperson be able to repeat what they've done. Sometimes the founders are not good enough on their own to do that, so I recommend that they bring in what I call a trailblazer pathfinder sales rep who's a specialist kind of person. They don't like to work with predefined motions that are, the meat and potatoes for an ordinary salesperson, but they're very good at helping you find the path and figure out what is the motion that you're going to teach to these more normal, ordinary salespeople that you'd bring in later on. And so at the end of that, you should have this really a defined notion of who you're selling to, what price point you're using, what message you use when you talk to them, what the objections are that they come up with, and how do you typically overcome those. All of these different elements of the sales motion have been figured out at that point in time and tested with more than one account. And now you're actually ready to bring on a salesperson and test out and see whether that works or not. And that's when you start working to see, is this thing repeatable when I bring in, just ordinary standard reps. And then once it is repeatable, then you try to figure out, okay, can we scale this? Can we add another 2 salespeople, and do they still both become productive in a short, predictable period of time, and learn how to do this motion that we think is repeatable here? And if that is scalable, then I think you typically see that you run into a churn problem very frequently around that stage, because now you become very good at signing up lots and lots of customers, and you start realizing, okay, not all of them are sticking around as long as we should do. So how do we solve that? So that would be step number 7 in that process. And then the last step 8 is let's make sure that this process is profitable, and really focus in on how do we reduce CAC and how do we optimize the lifetime value, and make sure we've got our metrics in order for us to really hit the gas on the thing. And so if you think about it, if you can make that motion repeatable and scalable and also profitable, you've actually built a cash generating machine. And it's really something that you want to run as fast as you possibly can do. Put as much money into it as you can do, because every time you put money into it, it scales and it repeats and it generates profit for you. So that's when you are ready to enter that last phase where you should hit the gas and just scale like crazy. And where I see founders going really badly wrong is they try to skip ahead, and actually board members and investors are very frequently responsible for this. And they will encourage them to hire a ton of salespeople before they've actually got a motion that is really ready to have those salespeople work on it. And they just burn a ton of cash, waste time, and end up discovering that they've got to come back and spend the time to finish off figuring out how to create this repeatable sales process. And it's much harder to do that if you've got 6 salespeople than if you've actually got a couple of founders and one other person working with you, because you've got tight communication and regular insights coming out of every meeting that you can discuss to do that.
Do you think, of course it makes sense. A bunch of follow-up questions. One of them is, it was always my understanding that Series A was about, to your point, still in discovery mode, maybe not discovering product market fit, but to that point of discovering repeatability. And then Series B, particularly at the size of the financings that we're seeing, sometimes 30 million, 50 million, sometimes even 100 million Series B. I see 100 million more at Series C these days. But these are very, very large investments of capital. And they seem to be, or at least some of the companies I've worked with, some of the companies I've consulted for, misaligned to where the business actually is. Is there a mismatch between the amount of capital in venture capital and the natural growth rate of these businesses to follow along through those 9 stages?
Yes, and there really can be, and it can be incredibly dangerous. And it's very interesting that you say that, because I literally just wrote, I think it was 2 days ago, an email to one of my companies that had raised a large sum of money, saying, it's essential that we get a board-defined plan in place, because one of the biggest mistakes that I see companies making after they just raised a big chunk of money is raising expenses way out of whack with where they are in the business process, this cycle of these 9 steps, etc. So yes, there's a grave danger here that you can raise a lot of money, and that will encourage you into thinking that you're ready to start scaling when you're really not ready to start scaling. And you need to follow the sequence of events here and keep your expenses tightly under control until you're ready to cover this whole series of steps to being repeatable, scalable, and profitable. And the reason why I say it's so important to control expenses there is that it's not predictable how long it's going to take you to either find product market fit or to get this repeatable, scalable, and profitable sales process. So the last thing you don't want to be doing is burning through all your capital and finding that you don't have what you needed to be successful because you tried to scale too early.
Do you find that that probably isn't a consensus perspective around the table of a board meeting, given some of, other investors may have exactly the opposite opinion, which is go, go, go. We gave you $30 million so you can spend it, not so you can leave it in the checking account. Does that put you in a strange situation sometimes with some of the companies where you're an early stage investor?
Yes, definitely. It's kind of horrifying that it's true, but I'm frequently the investor who's really arguing, wait a second, guys, we're not ready to do this. And let's just tame expectations down here. And let's finish the sequence of steps that we've got to go through before we are ready here. And strange enough, it's also odd for the poor founder when they come out the far end of that process. Like I remember the HubSpot guys in the board meeting where we told them that they were actually ready to hit the gas and start hiring 2 salespeople a month. And they really had a fit because they'd been saving money so carefully and not hiring people and being super cautious about any kind of expenditure. And now all of a sudden we were telling them to hit the gas. And they were sort of surprised that, wait a second, we're going from this one mindset to this other mindset, and realizing that, that's very stage specific. And when you really have the data that tells you you're ready to go, you've got to change mindsets. And I sometimes see, those same board members who are pushing too early are not pushing hard enough when they should be pushing hard enough, which is when the data really indicates that you are ready to go. So I'm often at odds with other players around the table and have to, justify my position and get people to buy into it.
Well, they should be so lucky to have you at the table in the first place, is my perspective. Now, you've done a tremendous amount of work. We talked at the top of the show about the science and the art of sales. And one of the things you've done a lot of work on is sort of funnel design. And you've looked at how funnels can unify and align an entire business all the way from sales, I would guess, all the way through to the engineering team and to the people that are building the product. Walk us through some of the insights that you've developed as a consequence of studying and thinking about and dissecting funnels.
Yeah, so the first insight is one that you've just said, which I just like to repeat because I think it's so powerful, is if you take a SaaS business, the funnel is one of the most powerful ways to align the whole organization so that they all understand what they're trying to achieve and are all pulling in the same direction. So as an example of this, let's take something like the product group. Well, in most organizations that I start working with, there's often a problem where the product group is siloed from the marketing group, that's siloed from the sales group, that may be siloed from the customer success group. But if you think about what's required to get a funnel to work, the product people can have an unbelievably powerful impact on whether a product sells well, because these days free trials are really one of the most potent weapons that we use in SaaS sales cycles. It's the product experience that determines how well that free trial is going to go. And from a customer standpoint, if that free trial goes great, it's a big reason why they're going to buy or not buy. So you need the salespeople and the product people and the marketing people and customer success people all aligned in a group that thinks about the funnel and where it's blocked at this point in time and what solutions we could use to address that. So sometimes the product people can be one of the most potent groups at solving those problems. Sometimes it's the customer success people that have to think about onboarding. Sometimes the salespeople are involved in fixing a churn problem because they're overselling the product. And so they need to change how they're positioning things and make sure that the compensation is aligned to prevent them from overselling and therefore having that customer just churn out a few months after they signed up, which is not great. So what I like about funnels is they can be actually brought down to two formulae, and that's incredible that you could simplify a business down to two formulae. So the first formula is the overall funnel. The metrics for success there are simple, which is how many people do you put in the top of the funnel, multiply that by the conversion rate, and then multiply that by the average deal size, and that tells you how much you're going to be booking in any particular quarter or month or whatever. So that's really nice and simple. And it's interesting because once you know that, then you start to realize, okay, if I can get our organization to double the conversion rate of our free trial, we will double the bookings that we have here. Or if we can double the number of people we put in the top of the funnel, we'd also double bookings. So you now have this really nice, simple formula that governs how well you're going to do as a business. And then the second thing that happens is once you start adding in salespeople, that formula that I just gave you there that's nice and linear doesn't scale linearly any longer because a single salesperson has a capacity limit. So if you bring in, say, one salesperson and you start bringing in more leads than they can handle, you won't get more bookings. You have to actually add a second salesperson. So you need a second formula when you have a sales organization. And the second formula is also nice and simple, thank God. And it simply says, take the number of salespeople you've hired and multiply that by the average sales productivity, and that will equate to your bookings. So if you've got 10 salespeople and each salesperson is capable of delivering 500K per annum of bookings on average, then you've got yourself a $5 million booking machine per year with that group there. So long as you keep that average productivity up as you add new salespeople, and then it doesn't drop. So it's super useful, again, to look at those two things. So one of the biggest mistakes I see people making is they don't hire fast enough. They think it's okay not to hire fast enough because they're kind of saving money by hiring slowly. But it really isn't. In a sales organization, one of the biggest reasons I've seen sales organizations missing plan is that they didn't have enough salespeople hired. They didn't have the sales capacity to do the business that they'd committed to in the plan. So you have to build a really grade A recruiting machine internally. And that is something that I talk a lot about on my blog, of the importance of being grade A at recruiting to create a good SaaS business.
I've seen, I was going to say, I've seen a bigger problem on the other side, and curious on your reaction, which is that when you're building a revenue plan, as you describe, salespeople times average productivity, the understanding of how demand is generated is obscured a little bit. And so the far bigger problem I've seen is people hire too many salespeople without understanding that salespeople need to be fed, and that they need to demonstrate an ability to scale and generate leads and qualified opportunities to feed those salespeople, unless they assume that the salespeople are going to be doing all of their own prospecting. And so oftentimes what I see is a very large sales team with not a lot to do.
Yeah. Actually, you are right, and I should point out that is a bigger problem than the one I described, where they didn't hire enough salespeople. That's the much more common problem, and it is exactly what I was going to discuss second, which was how do you get the sales productivity to stay constant? And certainly one of the big aspects of that is you've got to make sure you can feed them enough leads. And so one way that I recommend people do that is to have a reverse funnel math take place. So if you know that to close one deal, you're going to have X number of opportunities, because you know your opportunity to close ratio, your conversion rate. And then to get an opportunity, how many sales accepted leads do you have to have? And how many MQLs do you have to get one sales accepted lead? And by running that reverse math all the way through, you should be able to figure out, particularly importantly, is how many MQLs does marketing have to generate for this size of sales organization? And that now gives you the contract that you form between sales and marketing that aligns those two organizations around the exact same thing that they have to do.
Yeah.
And, that's so dead right. You really raised a very good point there. And it's fundamental to how you keep the productivity per salesperson high, is that you are able to feed them. But it's also interesting to note that there are other things that you can do to help sales productivity. Like one of them is doing a brilliant job of onboarding the salespeople and really teaching them about your business, about your customers, and about how to sell. And I see a lot of companies skipping over that and spending a lot of money to hire these very expensive people, and then just not putting the energy and effort in to make them productive. And that's clearly another mistake.
That's a huge.
But it's nice how the math of these formulae bring out this great discussion that you and I are having here, because you pretty quickly realize, okay, if we're going to make this math work here, then we have to get into these art questions, like how well can we do at onboarding salespeople, or what techniques are we going to use for lead gen, et cetera.
Yeah, no, I mean, it's the math that needs to be done to understand how the business performs. David, we're coming to the end of our time together. It's been an incredible conversation. One of the things we like to do at the end is pay it forward. We like to highlight either other, from your perspective, it could be founders that you have deep admiration for, maybe companies that you've recently invested in that you want to do a little free PR for, other investors that you think very highly of or that we should know about. Who are some of the influences or some of the people that you'd like us to know about that have impacted your life?
Yeah, that's a great point. So certainly inside of the set of people that have really influenced me, I obviously want to highlight some folks that people do know about, like Brian Halligan and Dharmesh Shah and the whole management team over at HubSpot. It turns out that group were just spectacularly powerful and helpful at influencing and helping me understand the SaaS business model. I was going on that journey with them, and they were terrific thinkers. They had all gone through, not all of them, but a lot of them have gone through the Sloan management program at MIT, the MBA program at MIT. So they thought with a very mathematically oriented mindset about the business they were building. And then one of our board members that we had at HubSpot was a person called Gail Goodman, who was the CEO and founder of Constant Contact. And she was really earlier to SaaS than we were. And so she brought in a bunch of ideas that were super valuable and important. So I'm always very grateful to Gail. Then we learned a ton from the folks at JBoss. The CEO there was extremely talented. There were many other talented people at JBoss. And also Zendesk was another organization where Mikkel Svein, who's the CEO and founder there, has been super influential on me and helpful in getting me to learn a bunch of different things there. So that's a group that I would give thanks to and say they had enormous influence on me learning what I learned.
I love it. There are folks that are listening that I'm sure are incredibly impressed. Maybe they want to reach out to you. Maybe they are entrepreneurs that want to talk to you about their business. Are you, I guess, two-part question, are you open to folks reaching out that hear you on the podcast? And if so, do you have a preferred method of communication?
Yes, very open to it. And email is generally the best way to do that. And my email is just dskok@matrixpartners.com.
Wonderful. David, thanks so much for being on the show. And we'll talk to you on Friday for Friday Fundamentals.
Perfect. My pleasure, Sam.
Hey, everybody. It's Sam Jacobs. This is Sam's Corner. What an incredible interview. It was really just an honor to have David on the show. I've been following David's career for a long time, and you can hear from the enthusiasm in his voice how excited he is to help founders, entrepreneurs, and their teams grow and scale businesses. And he talks about, you really need to go to his blog, forentrepreneurs.com, and go through some of the materials. But he talks about this critical step that is often missing between product market fit, and scaling, which is go-to-market fit. Mark Roberge has talked about this as well. It's when, before you pour gasoline on the fire because you think you've got, some embers glowing, let's make sure that you know how to start fires repeatedly, which I think is belaboring the metaphor a little bit. But the point is that there's 9 steps, and that too many people are focused on the first sequence, which is product market fit, the discovery process, and then scaling immediately from there. And not enough people are focused on the discovery process around go-to-market fit. Discovery meaning understanding what the price points are, understanding what the sales motions are, understanding where your customers live. I think it's just really, really important what he's talking about, which is before you spend a tremendous amount of capital, understand the business and how it works. And also don't misapply metrics. So if it's a super early stage company, it may not be appropriate to be talking about LTV. Especially if the company's only a year or 2 years old, then it doesn't matter. You can call the LTV 5 years, but it may not matter. I still think that understanding the general ideas behind the unit economics is important. And there, David and I may disagree a little bit. What I mean is that the numbers are always telling you something. It's important to understand what. And they're always telling you something about how customers are enjoying your product, what they think about it, and whether or not it's appropriate to keep going. And there, I think we both agree that listening and understanding the metrics, particularly LTV, particularly CAC, and particularly payback period, or as he calls it, months to recover CAC, I think is very, very important. I think one of the things that he mentioned is looking at gross margin contribution as the mechanism against which to understand how much you can spend on sales and marketing acquisition. The problem most of the time is that it's not quite clear how to measure gross margin in a SaaS business. It's not obvious because most of the time gross margin is whatever you sell times less the cost it required you to produce that marginal item. But the cost of software is typically zero. So figuring out software gross margin is complicated, and most people are probably going to be overly optimistic. At any rate, he's a much smarter man than me. And he's built a number of successive businesses. So I would really go back and listen to the episode again. We've got this Friday Fundamentals coming up. It's going to be one of the longest ones, I think the longest one, because he's going to walk you through what a buyer-centric funnel is. I would listen to that one as well. Matrix Partners is outstanding. And truly, David Skok is one of the earliest thought leaders, one of the pioneers of SaaS, and he's an operator, so he understands how businesses are scaled. So it's been a great show. Thanks for listening. Before we go, let's thank our sponsors, Conga, the leading end-to-end digital document transformation suite, and Outreach, the leading sales engagement platform. Remember, if you want to get in touch with me, it's linkedin.com/in and then /Sam F. Jacobs. Please do give our show 4 or 5-star ratings on iTunes so that we can be at the top of the heap and get more and more listeners and share some of these ideas with the world. And I look forward to talking to you soon. I'll see you next time.